latest UK inflation, unemployment and wage growth figures on Tuesday the 15th and Wednesday the 16th of November will capture a lot of the macroeconomic headlines in the next few days, but they in turn will inform what could be the most intriguing statistic of the week. That's the GfK UK Consumer Confidence Survey, and that's due for release on Friday the 18th of November. This study comes out monthly, and in October, the reading showed a very modest improvement of 2 points, as the GfK UK Consumer Confidence Indicator rose from an all-time low of -49 to -47. Meanwhile, the Major Purchase Sub-Index slipped again in October to -41, and only a couple of months in COVID-addled 2020 have ever undershot that, something which may help to explain why mortgage applications, house prices and car sales have all started to soften. Again, it's worth reinforcing the importance of the twin evils of inflation and unemployment when it comes to consumer confidence. This can be seen by comparing the headline GfK survey reading with Arthur Oaken's Misery Index, which is derived by adding the prevailing rate of inflation to the prevailing rate of unemployment. And it reinforces also the balancing act that the Bank of England has when it comes to setting interest rates. It can't let inflation run amok, but equally it might not want to put the hammer down too much with interest rates, as that could drive up unemployment. Equally, a sustained improvement in the Misery Index could boost consumer confidence and give companies which rely on discretionary spending a welcome lift as well. On the company front, a good dozen FTSE 100 members are set to publish full year or first half results or unveil a trading statement in the coming week. A good number of small and mid-cap names are due to do the same. Firms which may merit further research include the following, though do please bear in mind some of these dates could yet be subject to change. Informa on Monday the 14th, BAE Systems, Imperial Brands, Land Securities, Workspace, Vesuvius, Speedy Hire and Wincanton on the 15th, SSE, Sage, British Land, Experian, Hill & Smith and Premier Foods on the 16th, Halma, Spirax Sarco Engineering, Burberry and Virgin Money UK on the 17th, and Fuller Smith & Turner will close out the week on Friday the 18th. Even allowing for that lengthy list, however, the company which could just cause the biggest fuss in the week ahead is Vodafone. The telecoms giant and FTSE 100 member is slated to release its first half results for the 6 months to the end of September on Tuesday the 15th of November. The shares are down slightly over the past year, which may not seem too bad until you pan out and look at the longer term chart, because Vodafone shares are trading no higher now than they did in 1998, just before the tech, media and telecoms bubble went into absolute orbit. Activist investor Shavian seems to be cutting its stake and giving up, although Etisalat has now built a 9.8% holding at a cost of over £3 billion to make it Vodafone's biggest single shareholder. May's full-year results didn't help sentiment much, especially as the outlook statement from Vodafone targeted little if any growth in earnings or cash flow in this current year. That left many investors unconvinced that Chief Executive Nick Reed can coax improved earnings and dividend momentum from the group, despite a major reshaping of the business, thanks to multiple disposals, acquisitions, mergers, and even a demerger across the group's operations in Europe and Africa, which are now the strategic focus. July's first quarter update didn't particularly rouse investor sentiment either. Total reported sales growth was 1.6%, while underlying service revenues rose by 2.5% on an organic basis. The good news in the first quarter was a strong showing from the UK, where organic revenue growth was 6.5%, helped by price increases for overseas roaming, even if that was therefore less good news for British overseas travellers. There was unfortunately, however, less good news also from Germany, Italy and Spain, where revenues all fell on an underlying basis. Besides looking at the trend in quarterly revenue growth overall and by region, analysts will then look to benchmark these first half results against the two pieces of guidance that management's offered for the full year. The first is that underlying adjusted profits will come in between 15 and 15.5 billion euros, based on the metric of EBITDA. The benchmark is last year's 15.2 billion for the full year. The second piece of guidance is that free cash flow will come in around 5.4 billion euros before spectrum costs, and that compares to last year's 5.3 billion outcome. So I suppose a flattish showing in the first half wouldn't be the biggest surprise either. That then takes us to the dividend, which is paid in euros. After a big cut to 9 euro cents a share in the year to March 2019, the first ever reduction in the company's distribution, Vodafone kept the dividend unchanged in fiscal 2020, 2021 and 2022. The company is looking to develop what it calls a progressive dividend policy, but analysts are again looking for no change this year. That implies an unchanged first half payment, this time around of 4.5 euro cents, although currency movements may mean the figures move around a bit more in sterling terms. Note that this final graphic shows the dividend progression in pence, and that Vodafone does also continue to run a share buyback programme. More strategically, shareholders will look for any guidance on a range of issues, including the proposed sale of the Hungarian operations, an update on the German fibre to the premises venture with Altis's Patrick Drahi, who ironically has also been building a stake in BT, Turkey and how hyperinflation there is affecting the operations, any progress on the rumoured merger with Three in the UK, and any comment on the rumoured interest in buying the private equity-owned TalkTalk, which is also thought to be in talks with Virgin Media O2. I hope that you and your families are all in good health and good spirits. Thank you for watching, and I look forward to seeing you again next week.